Well, I think we have the technical difficulties figured out. Thank you for your patience. But we're excited to be with you today. We appreciate you coming out for this kind of reimagined event, the Craig Talks. And for the first time, we're going to have a discussion about capital markets. So to start off, Jennifer, why don't you tell us what's the definition of capital markets?
Yeah, sure. So capital markets are venues that allow us to take our funds from investors to investment opportunities through the sale of long-term financial assets, usually equities and debt.
Okay, I heard a lot of words there, but I got equities and debt. Aren't those code words for stocks and bonds?
Yeah, I suppose they are. And really, stocks and bonds make up a significant portion of our capital markets, especially in terms of the attention they receive.
Well, I agree. They're getting a lot of attention these days. I don't think much of it is positive, though.
That's true for sure. And it reminds me of this saying from Mark Twain, which is, I'm more worried about the return of my money than the return on my money.
Yes, I'm not one to disagree with Mark Twain. He was one of the first people to actually warn us about stock market volatility in October.
He did?
Yes, he was quoted as saying that October is a particularly dangerous month for stock market speculation. The others are January through September, November, and December.
Okay, well, all kidding aside, capital markets are incredibly important to all of us, believe it or not. So even if you're not trying to raise capital, a lot of us are looking for places to invest our money. And capital markets provide some of the most easy and liquid ways for us to do that.
And I think capital markets impact a large, different parts of the economy. I mean, think about real estate, for example. When you look at the cap rates on real estate, the net income divided by the value, as interest rates came down to historic lows, so did cap rates, also came down to historic lows. And now that we're seeing interest rates move up and mortgage rates have more than doubled, homeowners are finding it difficult to qualify for mortgages, and we're seeing a negative impact on the housing market. So yeah, the capital markets have broad impact.
Yeah, and the capital markets cover a lot of things. And so for our Craig Talk today, we're going to narrow it down and focus on three that I think we can all potentially agree have a significant impact on our capital markets right now. We're going to talk about inflation, recession, and earnings. So Roger, do you want to get us started with inflation?
Sure. Why don't we'll start with, I'll take the clicker there so I can use that pointer if I need to.
Please
but
do.
We'll start with this chart on inflation. And we see that the bar here shows the red line is the consumer price index, or CPI. It's a broadly used measure of inflation. The blue, that's the red line. The blue is the core rate, which excludes the more volatile food and energy. But we can see that after years of being relatively low, we've had this spike in inflation to levels not seen since Ronald Reagan was president. So this is definitely what's upsetting people. Mm-hmm. But we've had this long period where the red, we actually dipped down to zero or below. So we've been more worried about deflation than inflation. So this sudden rise in inflation definitely seems like a regime change. But no one's rooting for inflation. In fact, we talked about President Reagan. He had to suffer quite a bit of inflation, and this is what he had to say about it. Inflation is as violent as a mugger, as frightening as an armed robber, and as deadly as a hitman. So there's a lot of fear of inflation, and that's why the feds are taking it seriously.
Yeah, but I thought inflation was supposed to be transitory. Wasn't that the word they were using?
Yes, the Federal Reserve and others were definitely talking about inflation being temporary or transitory was the word they used. And there was a theory that there was a bubble of demand that came out after we reopened the economy and the markets after COVID, that this bubble had to pass through the economy. But once it did, that things would kind of normalize. We'd find some equilibrium between supply and demand, and that prices would moderate. But that didn't happen. And they point to external events as the reason for that. They look at things like the supply chain issues that we had, the trouble that employers had hiring workers. We look at the Russia invasion of Ukraine, and China's ongoing shutdowns as they kind of pursue a zero COVID policy. All those contributed to this being a problem. But the Feds acted decisively, finally, and we see here. We want to go back here. Here we saw rates come up quite a bit here. The green line is the Fed fund rates on this chart. It shows 3.25. We know today they raised it to 4%. So in just a few months here this year, we saw rates go up dramatically from 0 to 4%. Compare that to 2015 to 18, when rates went up 2.5% over a 3-year period. Very gradual. And on this chart, the blue line is the 10-year Treasury. The red line is the 1-year Treasury. You can see actually right now, the 1 year is higher than the 10-year. So right now, we're in what we call an inverted yield curve.
Yeah. And so why did the Fed take so long to decide to start raising rates?
Well, I think there was they've been battling inflation or deflation for so long, there was a hesitancy to all of a sudden raise rates and worry that they might cut off this COVID recovery that we had going. But I think the Feds definitely were concerned about inflation. They acted very decisively, but the markets didn't quite believe them. We saw them raise rates sharply here, but there was times in February, in March, and in May when people said, well, we've had peak inflation. And there was certainly some talk about the Feds needing to moderate if they were going to engineer what they wanted, a soft landing, as they called it. So there was that was happening, but Federal Reserve Chairman Powell was very decisive in saying they definitely were going to raise rates higher, and they were going to keep them there and do what it takes to bring inflation down, even if we had some pain out of a recession. And a lot of people were calling that policy 3H. They were going to raise rates high, they were going to hold them there, and it was going to hurt. In this chart here, we can see how the Feds, back at their September meeting, this is their own forecast for Fed funds. We'll need to revise it after this meeting, perhaps. But they were talking about raising rates to 4.5% or near 4.5% by year end, and all the way through next year in their efforts to bring down inflation.
Yeah, none of this sounds like fun. I mean, I know Senator Elizabeth Warren was even quoted as saying, what Chairman Powell calls pain means putting a lot of people out of work. And were others concerned about this, this push to raise rates and try to combat inflation now?
Yeah, I think there was a lot of people that questioned it. First, they questioned why they didn't raise rates last year when the economy was growing so strong and we had sharp price increases. I know that, and now today, when things are looking a little different, there's that question. Wharton Business School professor Jeremy Siegel, often a guest on CNBC, was quoted as saying the idea of raising rates, continuing to raise rates into 2023, quote, made no sense to him whatsoever. It was way too tight. And he points to things like home prices already starting to drop, oil prices having returned to pre-invasion levels, and freight rates dropping as reasons why it's a little premature, or the Feds are reacting a little too aggressively at this point. Other people look at things like retailers' inventories and say that some of the supply chain issues are still out there, but a lot of them have been resolved. Looking at retailers' inventories, after COVID, we had trouble getting back to those levels, but today we have record inventories. And people are talking about the idea that retailers are going to have to cut prices in order to get rid of excess inventory. And that would help fight inflation regardless of what the Feds do. And then finally, I think there's a lot of people talking about we're on the verge of a recession, that a recession is coming. They look at things like the leading economic indicators, which before every recession, they go negative. And what's happened recently? The leading economic indicators have gone negative.
Yeah, so what are the long-term implications of inflation then?
Well, there's two camps really when it comes to this. One camp says the Feds are aggressive on inflation, they're going to bring it down, and after a while that perhaps the deflationary influences that happened after the Great Recession are going to reemerge, and inflation's not going to be a long-term problem, and maybe we'll have to worry more about deflation in the future again at some point. And if they're right, then the companies and investments that did well after the Great Recession will probably continue to do well. And bond investors would want to look at this opportunity in higher rates, maybe to lock in some longer term rates. The other camp says, wait a second, there's a price to be paid for these easy money policies, all this stimulus that was put out there, the bloated Fed balance sheets, that there's a reckoning that has to happen. And inflation is going to be more persistent. And the Feds are going to have to keep rates higher than they're thinking in order to keep inflation at bay. And if they're right, then you want to look at companies and investments that do better in an inflationary environment, ones that can pass along price increases to their customers. Things like material sector businesses or commodity-based companies, or even emerging markets do well because they're commodity-based. You have utilities, healthcare, and consumer staple stocks all would probably do well. And on bonds, you'd probably want to stay with the shorter or intermediate term bonds.
Yeah. So what camp do you fall in?
Well, there's no easy answer here, and I think you can make a reasonable case for both camps. Yeah. But you know, the Feds have made it very clear that they are going to be aggressive on inflation, and I always believe that old mantra, don't fight the Fed.
That's true. Okay, so what is a recession, right? Okay, so technically a recession, we can define that as two consecutive quarters of negative growth in GDP. And even though we saw that in the first 2 quarters of this year, we're never officially deemed to be in a recession until the National Bureau of Economic Research has determined that we're in a recession. And they're looking at a broader picture of the economy when they're talking about a definition of recession, looking at things like personal income, employment, consumption, and industrial production. And if we think about these things, they actually look pretty good right now, right? So employment numbers are good. And in fact, if we think to September, the US had an increase in job openings again from 10.3 million to 10.7 million. Growth is there in income, in spending, and in production right now.
So things are pretty good?
Well, that's where it gets a little bit tricky, right? Because when we're defining a recession in that way, it's a little bit backwards looking. It's defining a recession in hindsight, right? And so when we actually look at these indicators and look at recessions over time, you're going to see that these tend to peak just before or in the middle of a recession.
Well, how do I know if a recession's coming then?
One thing we can look at is those leading economic indicators that you've already referred to, Roger. And a couple other things we can kind of look at are things like the GDP. So when you look at this graph here, the red line is indicating periods of recession that have been defined using that GDP definition, right? And you can see that they overlap every official recessionary period that we've had. And so we've never in recent history had contractions in the economy without seeing an official recession being declared. Now, the interesting thing to pay attention to this time that's kind of fun, or not fun, but interesting, is that we've actually had 2 quarters of decrease in the GDP. But in our 3rd quarter this year, we did see, even though it was slow, we did see some growth there, and they're projecting growth again in the 4th quarter. Another thing we can look at is this thing called the yield curve inversion. So this is, you referred to this already a little bit, when our short-term rates get higher than our long-term rates. And this graph here shows a red line, which is the spread between them. Anytime this line is dipping below 0, our curve has inverted. And the interesting thing here when we're mapping it onto recessions is every gray bar here indicates a recession, and you can see we've never had a recession without that inversion happening in the yield curve.
So what is the potential impact of a recession?
Yeah, so in general, there's some combination often during a recession where we'll see like incomes leveling off or declining. We'll see spending decreasing, the cost of living going up. We're kind of feeling that now with the current inflation we're experiencing. We may see job losses, we may see decreases in production.
But this time it's different, right? We've gone through COVID.
It is so different this time. There are some differences that we're seeing this time around. And one of them, and I bet a bunch of us have felt this, is the labor shortage, which has been unprecedented that we're currently experiencing, right? So this graph here shows unemployment to job openings ratio. And this low number here of about 0.6, what it really means is that for about every person available to work, there are like 1.7 jobs out there. And so once we start coupling this recessionary period with a labor shortage, we may see things a little bit different. So perhaps instead of massive layoffs, we may just see job openings decreasing. We may see companies finding more creative ways to cut costs so that they can retain these employees that they've worked so hard to get and to train. And I think overall, the hard thing about a recession is it's hard to predict how painful it may actually be. The good thing to know is it won't last forever. I mean, on average, recessions last for about 10 months, and each recessionary period is at least followed by growth, so there's something to look forward to. One other thing about a recession that's could be coming is that it's created a lot of fear, I think, right? And so some of that fear may be showing up in the volatility we're currently seeing in the stock markets. And so, Roger, do you want to talk a little bit about how that may impact earnings?
Sure. Earnings can be tricky. The price definitely follows earnings over time, but there was a business professor who once told his class, he said, there's a company X had $1 million in earnings over the previous 12 months, and asked them, how do we measure their success? And some students suggested they needed to know what the revenues were so they could calculate their margins. Others said, well, we'd have to know their industry and look at their competitors to compare how they're doing. And the professor said those are important things, but that wasn't what he was looking for. Finally, one student said, well, I guess it depended on what they expected to do. And that, the professor said, was the key. If they had budgeted to make $500,000 and they made $1 million, it was a great success. If they were expecting to make $2 or $3 million and they only made $1 million, then it was quite a failure. So growing earnings over time is important, but expectations play a huge role. And I think this chart is a good illustration of that. If we look back, this blue line is the S&P 500 stock index. The brown line is the trailing 12-month earnings of the S&P 500 stocks. And you can see how it kind of stair steps, and that's because companies report quarterly, so it tends to move in those discrete steps. The green line is the forecast for the next 12 months of what earnings are going to do. And that's from a consensus of the analysts. And if you look back at 2020, for example, when COVID hit, the market, the blue line, came way down, earnings sold off, and the green line also had a sharp reduction as they kind of factored all that in. But what happened after that? Well, earnings continued to decline for over a year. We saw earnings come down. But the green line rebounded as they started factoring in this expectation of recovery. And which did the stock market follow? It didn't follow earnings down, it followed the expectations up. So expectations are an important issue. And today, we've seen that green line start to turn down. But it's still, a pretty good level. They're looking for $232 in earnings for the next 12 months compared to $208 over the last 12. That's still a pretty darn good increase. And there's a lot of people that think that that number is just way too rosy. It's going to have to come down quite a bit. I know the Wells Fargo Investment Institute is forecasting earnings next year of $205 a share. That's quite a ways down from $232. But other thing to look at, though, is if you compare where earnings were pre-COVID, they were about 150. So even if we had a reduction in earnings down to 205 next year, on a relative basis, earnings are still 35% higher than they were pre-COVID. And that's with a market that's dipping down to levels not that much higher than they were pre-COVID. So we think there could be a coming opportunity here. Yeah. So Jennifer, what should we take away from our talks today?
Yeah, so there's some key takeaways we have here. First of all, the Fed is committed to bringing inflation down. A recession may be imminent, but may also be necessary. And don't panic. The economy and the market are resilient. So I know every time these things happen, we say, oh, but this time it's different. And in some ways, that is true. This time it is different. We've never faced something like the COVID-19 pandemic, and we don't know always exactly how things are going to come out after that, especially looking at how tightly knit our economy is through global trade and through technology. And so one thing to keep in mind is that there is something consistent with every crisis or breakdown that we've ever faced. And the consistent thing that comes out of each of these is that eventually it does end, which is hopeful, I think. Roger, how should people position themselves right now?
Well, it's hard to recommend one course of action for everyone, but I think maintaining flexibility and being patient are important, as well as probably carrying some extra liquidity. You don't want to be in a position where you're having to borrow money at higher rates that you didn't expect, or having to liquidate investments while they're down. But Wells Fargo investment analyst last month had written, a strategist had written that he doesn't think anyone can reliably call a stock market bottom at this point. And I agree with that. And so it might make sense to be a little bit defensive at this point. But you can't be defensive forever. Trying to take all risk out of your portfolio is not a good long-term strategy for capital markets. So you have to prepare a plan, and I think you need to look for opportunities to put that plan into action. And we think those opportunities will probably come in the next 6 to 12 months.
Yeah, this makes me think of a saying from Warren Buffett, which is, the markets are a way to transfer money from the impatient to the patient.
He's a smart man. And I'll close with a final nugget of wisdom from Wall Street veteran Don Connolly. He said, trying to get out with the idea of getting back in is trying to outsmart the market. And it's tough to outsmart something that doesn't always make sense.
Yeah, thank you.
Thank you.
Thank you.